Binky, what are your thoughts on this? Because I'm looking at credit at the moment, and high yield was very close to post-crisis tights, still is pretty close to post-crisis tights through much of this week, and then the spread widening came through. I think we've widened by about 40 basis points or so. Binky, is that enough to be concerned? It doesn't seem like it's enough to me. Is it enough to you?
I would argue no. It is, just mirroring what's happening basically in the equity market. So it's very temporary. In terms of, the discussion about what the Fed is going to do, I would say they're going to hike in December. They're going to hike 4 times next year. And as far as, 2020 is concerned, I wouldn't rule out continued rate hikes. If you look at where rates are relative to history, we are in a completely different place than a different plane. And the main justification for that has been that the neutral rate of interest, whatever that is, and whether you can measure it, has declined. If you plug in the revised BEA data into the spreadsheet that spits out the neutral rate, it just went up by 100 basis points on a data revision. And they're just telling you where I think this idea is going to go. Now, there's separate reasons to believe that inflation is not going to accelerate, but what I would argue is that's because inflation expectations are stable. The Fed inadvertently raised its inflation target by moving from CPI to PCE, and that's the main reason for why PCE is below 2% for the last 10 years. So there's only one word that I would argue you need to listen to Mr. Powell, and that is, as long as he continues to use the word symmetric in achieving inflation outcomes. I mean, inflation expectations are too low to have 2% PCE. So if you've been 10 years, too low, you need it to be above for 10 years to start to have a modest impact.